Hello and welcome to this special economy coverage. We are watching out for the crucial CPI and the IIP data. January IIP is seen cooling marginally to 5.4%, while the highly unpredictable and the volatile index of industrial production is seen contracting by around 0.5% in December. And if you talk about the estimates as far as the IIP is concerned, this time is seen at around 0.5% in the negative, and in the previous month, that is in the month of November, it was at minus 3.2% as opposed to a high 9.9% in the month of October. We are still waiting by for that data. Also, we are awaiting the January CPI, that's the consumer price index, which is estimated. All right, I understand it is at 5.69 as far as the CPI is concerned. That's a tad higher than estimates as far as our estimates are concerned. We were working with an estimate of 5.4% as far as the January CPI is concerned. That has come in at 5.69%. And remember, the RBI's January target happens to be 6%, so it is clearly undershooting in that range. And it's a little higher than estimates because your estimate of going ahead also was estimates somewhere between in a range of 5.2 to 5.4% going ahead into the summer months, also till the time you have the advent of monsoons and the cues thereof. All right, so I understand we have Gaurav Kapoor from RBS, Anubhuti Sahai from Standard Chartered Bank, and Shivam Chakraborty of HDFC Bank. As far as the CPI number is concerned at 5.69%, starting off with you, Anubhuti, what is your first cut on it? What do you make of it?
It's definitely much higher than our expectation. We were looking at a 5.35% print, so it is much higher than that. Though I have not seen at the breakdown, I am pretty sure that most of the upward surprise has been driven by food inflation. And if we look at the past few months, in fact the last 12 months, one of the most important reasons why we have usually seen an upside surprise is due to food inflation. And once again, it's possible that pulses might have remained a big driver, but once you take off the food inflation impact of the headline number, then probably we are looking at a much more stable inflationary trend, which has been at around 5.2% since the last 12 months. So definitely a bad news from the headline print, but the most important driver here has been food inflation, which as the pulse harvest arrives.
I'm sorry to interrupt you, Anubhuti. We have the IIP number as well, the December IIP number that has contracted by 1.3% as opposed to an estimate of around 0.2 to 0.5%. Is what we were working with. We are still waiting by for the component-wise breakup, and you have it flowing thick and fast now. The January fuel and lighting prices rise 5.32%. You have the food and beverage prices up 6.6%. The clothing and footwear is 5.71%, and overall you are seeing a contraction of 1.3% as opposed to an estimate of a 0.2% decline. As far as this number is concerned, Gaurav, coming to you, as far as the IIP print is concerned, it's an undershooting on that. What is your first take on it?
Well, in fact, IIP, my expectation was fairly close to -2, so I'm not entirely surprising. Slightly better than I had expected, because this is a month where typically, despite a seasonal increase in the index between November and December, the other factors which were the other indicators or which were available pointed towards the fact that this number is going to be still in the negative territory and perhaps closer to what we saw, maybe not as much as -3.2 clearly, but closer to what it was, because one, there was high base effect across the categories. Even the PMI in December fell back into the below 50 level, and on the whole I think the number is slightly better than I had expected. But yes, and in fact this is the month where you would have seen the impact of the Chennai floods more closely than it was visible in the previous month's numbers. So I think what would be interesting to see is the breakup in terms of how does the capital goods index, where too there was a fairly significant base effect, and consumer goods and their consumer durables, what kind of growth rates are visible there. But I think by and large in line with my expectations. Base effect actually continues to persist even in January, so the January number may not be significantly better than this number.
Right, Gaurav, the capital goods production is down 19.7% compared to the year ago period, and add to that electricity production, that's up 3.2%, and you have a mining output that has risen 2.9% compared to the year ago period. Your word as far as the capital goods production is concerned, that's a bump up, that's a fall of around 20 odd percent.
Yeah, but I think it's better than if you were to just take the base effect, the number would have actually degrowth in capital goods would have kind of you would have seen a negative growth of about 28%. But the fact that it is 19, which means that there has been some improvement in the index itself, so some traction back in capital goods, which is a healthy sign. Electricity, I think electricity and mining along the expected lines from the core sector numbers. Mining actually is slightly weaker than what the core sector data pointed to, but I think by and large, as I said earlier, the numbers are broadly in line.
All right, Shivom, coming to you, what do you make of the IIP print? Manufacturing has contracted by 2.4%. It is lesser of a contraction, of course, from the previous month, which was around 4.7%. While if you talk about mining, you have seen Coal India, the output is going up. There are some positive indications coming in there. Incrementally, you have seen some bit of an improvement as far as that sector is concerned. 2.9% of an expansion this time around. Your word on it, Shivom?
Yeah, I broadly agree with what Gaurav had said earlier. I think the current reading is sort of bound to be, at least shows up in the headline figure and the manufacturing figure is somewhat affected by both the base effect and the impact of Chennai flooding. Going forward, I think there are sort of the capital goods component remains sort of fairly volatile, and given that government cash balances have remained fairly high, and it's really been public capex that has sort of driven the investment drive, the drive in capital goods. There is sort of some area of concern as far as we are concerned going into the last quarter of this fiscal year, and all in all, I think we are sort of gearing up for a continued sort of very soft IIP readings going into the fourth quarter, really driven. I think just waiting for the consumer durables and non-durables figures, but I would assume that the real driver really continues to be consumer durables, which is urban consumption. There are signs that government spending has perhaps ticked down a bit from what we've seen over the previous 9 months, and overall it does point towards a fairly weakish sort of industrial production growth number going forward.
Right, Shivam, the consumer goods production has risen by 2.8%. What was your estimate that you were working with on that end?
No, I think we were about close to the 2.5% mark. So it is more or less in line with our sort of expectations. Again, I would sort of wait for the split between durables and non-durables. I suspect it's really urban consumption story panning out, with the rural sector continuing to remain fairly weak, given the sort of adverse monsoons that you have seen and the sort of cutback in revenue expenditure and welfare programs over the current fiscal year. So I think it's a sort of more or less sort of highlighting similar trends of what we have seen throughout the fiscal year.
All right, fair enough. Anubhuti, coming to you now, as far as the actual growth really is concerned, the 12% manufacturing number is not showing up on the balance sheet. What is your opinion on that?
Yeah, look, the most important takeaway from today's IIP print for me is that if you look at the third quarter IIP average, that is much lower. Probably it has dipped lower than 3%, significantly lower than 4.8%, which was the case in Q2. Now, that clearly is in contrast to what the GDP manufacturing print shows at 12%. So there is a probability that we will, going forward, we might see a downward revision in the GDP numbers, both for the third quarter as well as for the full year. In fact, looking at the trends on both the both the IIP side as well as what we think would be the trend on the consumption side, we expect that instead of the advanced estimate of around 7.6% on GDP, we are likely to see a 7.4% kind of a GDP growth number. If IIP does not improve in the last quarter too, as the earlier speakers pointed out, there is this whole negative impact of the capital goods which has dragged down the IIP performance in the third quarter of FY16. If that doesn't fade away, then probably the risk to our 7.4% FY16 growth forecast will be on the downside.
Right. Gaurav, coming to you, I mean, if you're estimating growth at 7.6%, is there really a case for an expanding fiscal deficit?
Well, see, clearly, in fact, if you look at non-farm, non-government growth in that quarter, it was, I think, it's close to about, it's in excess of 9.2%. But as Anubhuti pointed out, and I think I agree with her, I think there's going to be a downward bias to these numbers. And I think what we are essentially looking at anyways next year, the 7th Pay Commission will provide some stimulus, clearly a significant stimulus when it comes to consumption. Barring that, I think what one is really talking of, what we essentially are talking of, is a balancing or rather shifting of spending of the government towards greater change in composition in gradually towards greater capex, because that has a higher impact on the economy. The multiplier, long-term multiplier of capex by the non-defense capex by the government is about 2.4, which is almost 2 times more than the revenue spending by the government. So there is while clearly the GDP data is one, it is the IIP numbers which for the purpose of for the purpose of arriving at GDP estimates now account for about 31% of the GVA in terms of estimation. Rest 69% is from the corporate sector numbers, the data coming from SEBI. On the whole, I think Q3, Q4, second half of the year is going to be somewhat of a year where you will see growth lower than what you've seen in the first half. Capex clearly from the government side, especially to meet its fiscal deficit target, is slowing down, going by the cash balances build up with the RBI. So I think on the whole, with some stimulus coming in from the Pay Commission and from implementation of OROP, and I think the welfare schemes also, considering that you had 2 years of bad monsoons, the government may actually have to look at increasing spending there. I think it would be to me, I think it seems it would be somewhat difficult to keep at the fiscal deficit at about 3.5 in the next year. It may, but that said, I think it would not be more than about 20 to 30 basis points higher than that target, if at all. Because clearly on the revenue side, disinvestment targets have, again, that's something, it's essentially a black box. On the other side, if the economy does pick up, and it seems the signs are that this is going to, this slowdown phase or this phase of consolidation will persist for at least another couple of quarters, and the global economy actually taking a turn for the worse in terms of growth and in terms of growth of trade, I think the revenues will also be somewhat next year, and especially going in next year, the savings you had from oil may not be there. It's quite likely that you will not see, even oil prices have already fallen quite sharply this year. So on the whole, I think I think there would be some slippage in the next year's target, but that said, I would continue to see how is the composition. Is the government increasingly looking to put the central government increasingly looking to orient its spending towards capex, because all said and done, capex is still about not more than 2.5% of GDP.
Right. Gaurav, continuing with the OROP impact, I mean, what kind of an impact on inflation do you see on account of the OROP or something like a 7th Pay Commission? I mean, here we keep talking about its impact on stocks and consumer durables and automotive counters. But as far as inflation is concerned, how much do you think is that likely to feed, and what kind of an impact are you factoring in that regard?
Well, I think in the past, from what I can recollect, I think the 6th Pay Commission, which may not at this stage be a fairly good example, considering that you have considerable slack in the economy, in the manufacturing sector particularly, global commodity prices are continuing to ease, and rural consumption is clearly on the weaker side. So I think the impact this time around would be, I would think, and then depending on how the monsoons pan out, because clearly from today's print it seems that food inflation actually has inched up against my expectation that it would go down slightly between December and January. I would think that initially the impact, and remember the impact of pay commission is visible over the next couple of years. So it's not as if it kind of settled in the first year itself, but I guess in 2017-18, because of the base effect, you would see some equalization. But I would think somewhere around 30 odd basis points is what I would think at this stage, considering that you have considerable slack in the economy, and generally there are you kind of continue to see disinflation across the world.
Right, Shivom, coming to you now, do you anticipate that the fiscal deficit target will be met with as far as the fiscal year end is concerned? And also, given the fact if you're looking at an expansionary fiscal deficit, in that regard, does it jeopardize the medium-term inflation target?
As far as the current fiscal year is concerned, I think the fiscal deficit target should broadly be met. You have certain areas of slippage. I think disinvestment targets have probably been missed. There have been some sort of tax revenue shortfalls, but you have sort of gains from the oil subsidy front, streamlining of expenditure, PSU dividends. So I think this year, yes, the fiscal deficit should broadly be met. We sort of don't expect any substantial amount of slippage at all. The real challenge will be next year. I think as far as whether the government can stick, I think given the kind of the kind of investor environment or the risk environment that you have, I think the government will come under pressure to maintain its sort of 3.5% fiscal deficit target. Yes, there are sort of number of areas of that the focus needs to be on. There needs to be, of course, has to accommodate the pay commission hikes. But the pay commission hikes, it's sort of still somewhat unknown as to how it will be implemented. For instance, it could be staggered over the course of this fiscal year and the next fiscal year, and that could provide the government with some room to sort of continue with its public capex cycle and maybe try and revive the rural economy. But I think the headline figure, given the kind of risk environment that you are in, and the focus is squarely on the fiscal deficit target, we think that the government will perhaps the arithmetic will sort of work out to a 3.5%. How things are implemented, I think the pay commission could be staggered, and that's something that we expect.
Anubhuti, coming to you. All right. Anubhuti, coming to you, as far as the inflation is concerned, what is your view on the food inflation as well as the pulses inflation? I mean, that has of course shown a spike up. Food price inflation at 6.85% this time around, as opposed to 6.4% in the previous month. Vegetable inflation is at 6.39%, 4.63% in December. Take a look at the pulse inflation is 43.32%. That's cooled off a little. Rural inflation at almost 6.5%. What do you make of this, and how does the CPI stack up in your view going ahead into the summer months? Do you expect it to be ranged between say 5.2 or a 5.4, and this spike up, do you see it as anomalous, as also going ahead into the monsoon months?
Now, this is the third month when we have seen food inflation surprising on the upside, and therefore to say that next month we'll see a sharp cool off in food inflation, I think that will be jumping to conclusion too soon. So given the kind of dynamics which we are seeing on the pulse side, the kind of dynamics which we are seeing on the vegetable side, I think we will have to stay with a CPI number of higher than 5.5% for next few months, and going forward in FY17, a lot would depend upon what happens to monsoons. Now, if actually monsoons are normal and pulse harvest turns out to be much better than what was the case in the previous year, on its own it can take off at least 50 to 60 basis points from the headline inflation. So yes, it looks pretty challenging for the next few months. I think at least for next 2 to 4 months we can continue to see CPI staying closer to 5.5% with an upside bias. But going forward and progressing further in 2016, especially in the second half, once we get the monsoon and harvest, we can see inflation coming off significantly, especially when pulse prices come off.
Right. Shivam, we were talking about the consumer durables and the non-durable split. The consumer durables growth, that has come in at 16.5% as opposed to a 12.5% number in the previous month, while the non-durables has contracted a little lesser, 3.2% as opposed to 4.2%, 4.7% in November. What do you make of these numbers, and do you see a sustainable bump up in the consumer durables growth going ahead?
I think what this sort of highlights is something that I was talking about a little earlier, that you have this urban and rural sort of divide, where the rural sector has sort of taken a hit given the sort of adverse monsoons, the sort of fall in sort of rural wages, and urban consumption has benefited in effect from fall in prices, as well as sort of there's been some evidence of pickup in leveraged consumer spending if you would look at retail credit data. So yes, I think there is scope for continued strength in the consumer durable sector, and I think this will sort of remain as one of the supports, at least for the IIP, for the remainder of this fiscal year and maybe for the first half of next fiscal year.
Right. Shivam, we have seen, talking a little macro now, we have seen the kind of global money supply action. We've seen the Japanese central bank as well as the ECB hinting on some kind of easing. As far as money supply is concerned, do you expect monetary tools not to be the key driver of growth going ahead?
As far as the Bank of Japan and the ECB is concerned, I think the general sense in the market, and the main fear is really given the fact that the Bank of Japan and the ECB have adopted negative interest rates and the possible implications that it could have for banking sector profitability. So the recent sell-off that you've seen in the equity markets over the last sort of week is really reflecting that fact. I think if you were to look at balance sheet recessions, if you were to just draw an international experience and see how economies have come out of balance sheet recession, the main focus of the main tool has really been fiscal policy, with monetary policy playing a sort of a supporting tool by keeping interest rates fairly low. So to say that monetary policy does not have a role is perhaps mistaken. Monetary policy does have a role, but I think to come out of a recession and to really drive growth and pull it forward, it really has to be, the onus has to be on fiscal policy. So I think the distinction needs to be made that yes, monetary policy does play a role, but perhaps the overall effect is a bit limited when you have stretched balance sheets, when you have particularly with central banks moving into negative territory, right? There are concerns about banking profitability. So I think on balance, would still think that monetary policy does play a role, but fiscal policy has to do the real heavy lifting. For instance, if you look at the US case, and I'm sort of just diverging a bit from topic. If you look at how the US came out of the recession, it was really the initial fiscal stimulus, and then it was extremely accommodative monetary policy that sort of resulted in a more sustainable growth in the US economy. As far as the Eurozone is concerned, the ECB will probably turn further accommodative. You have, if you look at the fiscal numbers in the Eurozone and so on, you have a much lower quantum of austerity creeping in, and migration, spending on migration, particularly in the German economy, is picking up. So I think that will sort of drive the recovery. The current sort of fears that are being driven will perhaps somewhat overdone, and there could be some sort of respite, maybe not in the immediate future, but definitely going ahead.
All right. Gaurav, coming to you now. We keep speaking about the Housing for All scheme, the Amrut. And the home building scheme, the home building theme is mostly what we've spoken about. So you have your cement companies, tile companies, your appliance manufacturers in the same breath. You've got your housing inflation and the fuel and light inflation that has remained mostly stable. What do you make of this data? And in the same breath, speak a little about the schemes and the initiatives that are being pushed by the government. How does it stand in that stead?
Well, housing inflation, in fact, services on the whole, I would not only look at housing, I think if you look at services on the whole, and by the way, petrol and diesel are included in transportation within services, whereas fuel and light is, and that's where most of the reduction, even there, in fact, the government has actually of late has kept with it most of the savings in the form of higher excise duties. I think so. On the whole, services put together is where you have seen fair degree of stickiness on inflation. Because if you see, for instance, the core inflation in the last 3 months, it's been gradually inching up. So housing, definitely, that's an area where I think efforts to reduce reduce the kind of demand and supply mismatch, which will all these government schemes and initiatives will bear fruit over a period of time. So I think in the meantime, services inflation will remain fairly sticky, and that is that you can see across sectors, especially in urban areas. When you look at housing, you look at education, you look at healthcare, and I think that's where and that's something which RBI has actually been pointing out time and again, because services is a non-tradable sector, and it is now clearly structural constraints there are now visible now that we are focusing on CPI for monetary policy formulation, and given the kind of rapid pace of urbanization, given the fact that as per the last economic survey, close to about 557 million people will be living in urban India, or rather would be living in urban centers by 2030. There is clearly a gap which needs to be filled, and I think till that happens, you will continue to see a fairly this stickiness in services sector. Overall, clearly because of the fact that these are non-tradable largely in nature, the level of competition is fairly low as a result. And there are of course these, but that said, I think the supply response, starting with coming from the government, will gradually over a period of time, especially in the rural areas, will see inflation come down. But I think that's still, to my mind, a long shot. Will maybe not play out in the next year or so, maybe over a fairly longer period of time. But it's an area where now I think there is focus, because earlier, because when we were looking at WPI for formulation of monetary policy, services sector was not clearly, the inflation in services was not getting clearly reflected. But now the fact that we have the central bank talking about it, I think this is to some degree the awareness about it is increased, and even as a social objective from the government side, housing for all is an area where they want to push. And I think gradually over a period of time, especially in the rural economy, in rural areas, you will see this, you will see the impact of that, because clearly, as you pointed out earlier, and as we've seen in the past couple of readings of CPI, rural inflation, rural CPI remains higher than the urban CPI, and that to a large degree I think is because of the fact that you have logistical challenges, you have distorted markets, you've not seen maybe the composition of rural consumption basket clearly does not have that much higher weight on petrol and diesel, where anyways prices of late have been flat. So I think while the government's initiatives are well intentioned, the implementation and the delivery will take time. And in the meantime, I think we'll have to contend with the fact that we'll continue to see fairly sticky services inflation, and that's why I think even RBI is looking only to gradually bring inflation down in terms from 6 to 5 and not any faster, because as Anubhuti pointed out earlier, a large part of the food inflation is because of pulses. And in fact, if you look at the contribution in the last couple of months, contribution of pulse inflation itself has been almost as much as has been the contribution of the services put together, the miscellaneous categories put together.
All right. Yeah. All right. Fair enough, Gaurav. For dearth of time, pardon me for that, but we'll leave it at that. And just for a roundup, the IIP has undershot the consensus estimates at minus 1.3 as opposed to a consensus of minus 0.5, while the CPI has shown a spike up, expected at 5.4, is coming at 5.69. Let's see how the markets absorb this when they open up on Monday, especially given these turbulent times. And most importantly, given that this was the last data release before the forthcoming budget, it will be extremely important given the fact that RBI's target also in terms of inflation is more or less in line. Well, that's it for now. News and updates continue on the other side of the short break.
Any slowdown global level, which just means a lot more opportunity for India.
I think as long as we continue to focus on the customer, continue to build for the customer, we will always continue to grow.
I'm not sure whether Indian IPO market is yet ready to absorb a large